and go now. 9 o'clock is the new midnight. I'm so sleepy at 9 o'clock now. And so I sleep, and I still sleep about 4 or 5 hours, and many times I wake up because I'm used to that 4 or 5 hours, but I get so sleepy at 9.
4 or 5 is all I do,
so
but it's usually after the sun comes up.
Yeah.
Morgan's wife is so pretty. Sorry, I'm just
you're
loving
so
it.
sweet.
That's the first time I saw her. Morgan is my student in my business plan class right now at a college. And Crystal's on LinkedIn, Susanna's LinkedIn. Put your LinkedIn guys in there. And Juan, his handsome self is not on right now, but it's okay. So Troy, what did you guys talk about?
We talked about a little bit about military. You got 2 other veterans. I'm a veteran, so we got these veterans on here. So I was excited about that.
Too.
Yes, and
Susanna too. Susanna's a veteran.
Okay, what branch?
I was a cavalry officer.
All right. Thank you for your service.
Thank all of you for your service.
Thank you. So we are so we just kind of share where we were from and a little bit about ourselves, kind of what you asked us to do, and people were able to share what they expected to get out of the class today. So I'm excited to be here, and I said a shout out to you. I told them how I met you was through I was in a event with America Supermom, and America Supermom, I've done some things with her. She's a great person to connect with. Dr. CJ loves people, and love educating people and kind. So another great person to connect with. So I'm grateful that God put me in the path of some great people to be able to just make an impact.
So basically, I gave you permission to talk smack behind my back, and you didn't do it? What? I'd be like, where'd you
You're
meet her?
too
I don't
cool.
know,
We
she's
love you
crazy.
too much.
Oh my God. Okay, Troy, take it away, sir. Go ahead.
All right. Let me get started. Everyone, thank y'all for tuning in. Let me find my presentation because I can't find it right now. Okay, there it is right there. All right. Y'all see my screen?
Yep.
Awesome. All right, let me go here. All right. We good? Everybody can still see me?
You're good.
Yes.
All right. Hold on. I need to do something real quick. Slideshow. Yeah. All right. And let me go back. All right. So thank y'all for this opportunity. This is strictly educational. Again, thank you, Dr. CJ, for this opportunity to be able to share something that I think will be beneficial. For some, this may be, elementary, but some, you might be looking at, oh, well, this is not advanced. So for those that don't know, this is the How Money Works essential class. It's Stop Being a Sucker. I am Troy Holt. I'm your financial educator in this section, and I want to give you a start of a financial journey. The first decision you must make is simple. Will you choose the mindset of a sucker? It's a choice. The fact that you've joined this class today is a sign that you're on the right track, and you'll understand a little bit more why the subtitle is Stop Being a Sucker. But the great news is you don't have to be wealthy to think like the wealthy. Some people think that they have to be wealthy to think like the wealthy, but you don't. You only need knowledge and action. And today, this is your opportunity to gain knowledge and to take action. Financial literacy is the #1 economic crisis in the world. And we know the word sucker, we know it sounds insulting. Unfortunately, the best way to describe someone who can be taken advantage of and not know how things work, not knowing how money works does suck. It can suck up your time, it can suck up your freedom, and it can suck up your income. And that truly sucks. I don't know if you're aware, but over 5 billion people in the world considered financial literate. This is really shocking because there was a study done and 30% of the people in the world are considered financial illiterate. this study showed us that the vast amount of people, they took a quiz, and this quiz only showed that 30% of them were financially illiterate. Can you believe that in America, almost half of Americans don't have enough to cover a $400 emergency, or to make the student loan payments on time, or to even pay off the credit cards? And some are considering retiring. In 2020, now we know this is 2023, but in 2020, the number of people on unemployment went up, stock market went down, and we've seen how the numbers, they've fluctuated. Some of them came back, but we understand that this is a problem. This is a big issue. Now, how did this happen? One way is, did you guys know that only 21 states have a class in money? Did you, if you knew that, put it in the chat. If you knew that only 21 states offer a class in money. Now, Florida added theirs. They passed a law last year, so there'll be 22, and there's a couple of other states, I think, that have added. So, but if you knew this, put it in the chat, yes or no, that you knew that only 21 states offered a class on money. Do you think that's enough? What percentage of the schools teach sex education, teach lacrosse, broadcast journalism? Almost 50%. But as we can see, only 22 out of 50 states teach personal finance. Meet the sucker. It's a trap. Foolishly spending and low interest saving that goes on month after month, year after year, slowly sucking away your potential to be wealthy and free and in control. Every couple of weeks, the cycle repeats itself. Too much eating out, unnecessary online purchases, another streaming subscription. This keeps going on and on and on. Most people know how to earn and spend it, and that's it. What about all the other options? It's time to break the sucker cycle. Now, think of your retirement. This is a big issue for a lot of people. Think of retirement like an airplane. It needs both wings to fly, Social Security and 401k. If you have one, you can make one wing of the income you plan to live on in retirement, and the other wing is completely up to you. You're responsible. If you hope to live at least on 70% of your retirement income, you need to put away some serious money. In reality, the numbers are dismal for millennials, Generation X, and baby boomers. All of them are in trouble when it comes to the second wing. Will you have enough retirement in savings? If so, place it in the chat. If you think you have enough for retirement and savings, please. I see Amber says you have to have it to graduate on the class. Missouri does not. So it's important that we start with our children. Now, does anyone understand the power of compound interest? The power of compound interest refers to the growth potential of money over time by leveraging the magic of compound, which is interest paid on the sums of deposits plus all interest previously paid. Or as Zoe said, it's interest upon interest. Now, there's a difference between simple interest and compound interest, and the difference is substantial. With simple interest, you take $1,500, it grows to $8,250. Not much for such a long time in 50 years. With compound interest, that same $1,500 grows to $132,000 in the same 50-year period, 16 times more. Notice how the curve of this graph gets steeper in the years as the power of compounding really takes place. $178 saved each month from ages 25 to 67 at different returns create various results. Most people don't understand this, which explains why they choose to place their money in unfortunate places. The amount per month and the time are the same. The only change is the rate of return. This could mean as much as 797%. More money at 9% versus 1%. That's almost a $900,000 difference. As you can see, the rate of return could be the defining factor that closes your retirement savings or the gap that leaves you with a significant shortfall. The great scientist Albert Einstein said this is one of the most powerful force he had ever discovered. Now, we've all been guilty of squandering time, especially costly when you lose the value of money over that time. You never get the time back or the money lost. And there are 3 action steps that you can start now to leverage the value of money. Start now, save regular, and be patient. Starting early is always a good idea. It makes significant difference. In this case, savings from age 22 to 30 is better than ages 30 to 67. It's $110,000 difference or 4.75% less money. Here's a picture of the numbers that breaks it down by age. For each million you want at retirement, you can see the monthly amount you need to save to hit. At age 30, you need to save $282 per month to have 1 million. At age 40, $731. At some point, you will outpace your ability to hit the monthly savings required. You simply can't afford it. At that point, you have 2 choices. You can shrink your dreams or find a way to earn more money. Now, this is called the $1 million baby. This is a strategy that you really want to look at and check out. Did you know that only 20% of children will receive an inheritance? It's probably even lower now that so many people have faced the challenges of the pandemic. If you want to give your children $1 million at their retirement, which is more realistic, you either give them the $1 million in cash, or you develop a plan to save a fraction of that amount for each child when they're young. Now, we know that life is hard for retirement age parents to preserve an inheritance for their adult children, with seniors living longer. Almost all their savings may be required to cover decades of expenses, including medical bills, long-term care. And this new reality of longevity can remove the possibility of leaving an inheritance the old way. When I first started this industry in 2000, one of the things that they really focused on was retirement. But what they really didn't anticipate was the expenses of healthcare for seniors, because it exploded. And sometimes seniors spend so much money just on the healthcare. So this is a big issue, a big challenge that we're going to face, and it's not getting better. So could you use the money principles you've learned today to save 1 million for your child or grandchild? It's easier than you think. Let's take this first example. Dana, she puts $13,000 aside one time, leaves it there from her daughter's birth until her daughter turns 67. It grows to be 6.5%. It grows at 6.5% to over $1 million. Now, if Dana waits, she procrastinates. The child graduates from high school, she only receives $300,000 at age 67. 18 years, she loses $700,000. A big, significant change. What about Hector? Hector, he doesn't have $13,000, but he wants to leave his child $1 million. So he and his relatives, they come together with a plan. They save $2,500. And then for the next 4 years, he put in $250 a month. Then, bam, like magic, at age 67, his son has $1 million. If Hector's procrastinate just like Dana, wait till he's 18, he's going to be short about $700,000, only $300,000 difference. Now, you see why this strategy is called the $1 million baby. How appreciative would your kids be one day, perhaps when you're gone, that the parents thought about them enough to set aside a plan to set up the $1 million baby. If you have heard about the $1 million baby, put in the chat, give me a hand raise in the chat if you've heard about the $1 million baby. Have you ever heard about this particular strategy? This is a strategy. These are strategies. Anyone? Let me check my chat here for a sec. All right, take the presenters view. Okay, Dr. Leland, can't see that good?
No, I can see the presenter's view, but I can't see the presentation well.
Got it. Okay, let me see.
If you want your presentation notes, I can do the presentation itself, and then you can read your notes.
Okay, yes. So
Okay.
you're gonna take over for me?
Yeah.
Okay, all right. The tech whiz and the educational whiz.
I think. Hold on one second.
Okay. Awesome, Crystal. Crystal said her mom implemented this for her elders. I love it. Love it.
Why am I doing that? It's this one, right? Is it this one? Can you see?
No, I can't see. Are you taking over? Because I can't see. Let's see.
Yeah. Oh, because you're still on presenter's view.
Okay, all right. Let me take off that.
Take off your share and then I'll share.
Okay.
Everybody there, I also made sure that you guys have it. I don't know if you guys saw that. The HMW Essential PDF. Troy, that's Troy's presentation, just in case you guys wanted to see. All right. So who has $1 million baby in here? Not that I would visit you or anything. I just wanted to know, like, who has $1 million baby?
Crystal's eldest son has he has almost $500,000.
Oh, really?
Yes.
Anybody
Say
else?
it.
You can't hook him up with your daughter. They're the same age and in California, but he's gay.
Oh my God. Anybody else? $1 million baby. Don't tell my kids. They're just waiting for us to probably die. I'm not saying that, but can you guys see it now? Or no?
Yeah, I can
Yes.
see. Yeah.
Okay. So then we are, where were we, Troy?
Keep going.
We were on Hector. Weren't we on Hector?
Yes, we was at the end of the
$1 million baby. Are we
Yeah.
here? No, we were at 3 realities. Did we have this one?
Keep going.
We're here.
All right, right here. Yes. Okay. Now, the rule of 72. Has anyone ever heard of this rule? You can say yes or no.
Nope.
All right. I see Amber shaking her head. Can't see anybody else. All right. If you don't remember anything else, make sure you remember this. This is a mental math shortcut. So the rule of 72 is you take 72 and divide it by the interest rate. So let's say you're getting a savings account of 1%. You take 72, divide it by that 1%, and that answer tells you how long it takes your money to double. 72 divided by 1%, it's going to take your money 72 years to double. All right, next slide. All right, 1%, 72 years to double. 3%, 24 years to double. 6%, 12 years to double. At 9%, 8 years to double. And then I can't see the bottom. Let's see, let me move this. 12%, 6 years to double. This is called the rule of 72. It takes, if you're getting 12% interest on your money, it would double in 6 years. Next slide. Now, as you can see, there's almost $10 trillion in passbook savings account. The average is 0.9%. Look at the major banks, what they're paying on average on savings accounts. Some of them are 0.01%. Not even a penny.
Horrible.
Yeah, terrible. Next slide. So 72 divided up by 0.09, it's going to take you 800 years for your money to double. And as Hector says, Carr says, I'm sure your great grandchildren will be thrilled. In other words, $1 in 2020 would become $2 by 2820. But now we're in 23. So in 28, 23, it would take your money, that $1 would double to $2. Now, this works also on the negative. 17% is the average interest rate on credit card offers by banks. Take 72 divided by the 17. The banks make their money in 4.2 years. Their money doubles. This is why this is important, that I want you to make sure, if you don't remember this rule of 72. It takes 4.2 years for the bank or credit card company to get their money. Next slide.
Time to cut those credit cards.
Yes. Now, 7 money milestones. Next slide. We're going to cover 7 money milestones. This is a roadmap or blueprint to financial independence. As you can see, financial education, proper protection, emergency fund, debt management, cash flow, build wealth, and protect wealth. This is what I teach, and I advocate for people to have a roadmap or a blueprint to get to this financial independence. Next slide. So financial education, number 1, become financial literate. We have Google, we have also YouTube. There's a lot of misinformation out there, so be careful. But you can find some good information with these type of Google and YouTube. So also some books, you can read some books. Rich Dad, Poor Dad is a good book, and there's a few other books, The Psychology of Money. But also part of this financial education is get with a financial professional that you trust. Next slide. So 2 tools, financial education, and then also financial professional. These are very important. Next slide. So proper protection. This is milestone number 2, protect against loss of income and loss of savings. Next slide. Now, a good rule of thumb for life insurance is 10 times your annual salary. That's just a rule of thumb. When I deal with people, it varies because we go deeper, but just a rule of thumb, it's 10 times your annual income. If you make $50,000 a year, then you should have at least $500,000 in coverage. If you make $100,000 a year, $1 million in coverage. It's a rule of thumb. Next slide. Now, how much should you need? We talked about the rule of thumb, but when we look at the person's age, health, debt, dependence, their income, their role in the business, this could vary on how much is needed. And then also some of those affect costs. Next slide. In America, only 59% of Americans have life insurance. And then of that 59%, 50% of those are underinsured. And most people think they underestimated the cost. And so therefore, that's why they underinsured or not insured. Next slide. There's 2 types of life insurance. Temporary or term life insurance provides check protection, either 10, 20, 30 years. There's a couple of carriers that can do 40 years. It's the most affordable life insurance. It's pure life insurance. And then after that term runs out, the life insurance expires. Next slide. With term, if you have children, if you have a mortgage, if you have children in college, you have a business, term insurance, because you have this responsibility, may be important at this particular time. Next slide. When the term ends or when it runs out, you got 2 scenarios. Number 1, you no longer need the term life insurance, or number 2, you still need the term life insurance. Next slide. The financial wave, you have more responsibility typically when you're younger, and you have more debt. As you get older and you pay off debt, you have less responsibility, more wealth. Next slide. The next one we have is what we call permanent life insurance. permanent life insurance is insurance for your whole life. It's designed to, as long as you pay the premiums, to keep that life insurance in place. Next slide. Now, what's important about a permanent life insurance? You get the life insurance. You also have optional long-term care riders and other optional riders. And then also the third benefit of a permanent life insurance, you can build cash or equity like buying a home. Term is like renting a home. Permanent is like owning a home. Next slide. With the cash in a permanent life insurance policy, you can buy your car, you can take vacations, you can pay for weddings, you can have a supplement to retirement. But the powerful cash advantages of permanent life insurance is this in its right corner: tax-free growth, creditor-free, in most states is exempt for creditors, zero market risk, tax-free income. Also, it's not counted as an asset if you start doing financial aid for your children to go to college. And when you fill out the FAFSA, the cash in a permanent life insurance policy is not considered an asset to calculate assets under that financial aid. Next slide. Long-term care insurance, this is important. This is an optional rider. 70% of the people over age 65 would need some type of long-term care. 8% of people over age 55 have purchased long-term care insurance. Long-term care insurance, I told y'all, health care for seniors is going to skyrocket, and the cost continues to exceed. I just did a meeting with some healthcare professionals, and then here in Pensacola, the average for, go to the next slide for me, see, Dr. CJ. The average long-term care stay is 3.9 years. As you can see, the price down, but look at a private nursing home room, $100,000 for annual medium cost, but the average total cost is over $400,000. This is an old slide. You see $391,000, but it's over $400,000 for an average of 4-year stay. Next slide. So with long-term care, you have two options for long-term care. Traditional standalone policy you can purchase is very expensive and it's hard to get it underwritten because of health challenges. Or you could do option number 2, make it a rider on a life insurance policy. It's less expensive and the underwriting is not straight. And underwriting means someone looks at it and looks at the risk and see if you qualify for the insurance. Next slide. Also with permanent and some term life insurance policy, you have what they call living benefits. If anybody heard of living benefits, put in the chat. So living benefits basically pays you not when you die, but when you're alive. Living benefits include critical illness. If you have a heart attack or a stroke, you can get a portion of the death benefit and pay bills, pay medical bills, pay a mortgage, pay rent, whatever is your money. A doctor does have to sign off on it. You also have chronic illness riders where if you have diabetes, I'm a type 2 diabetic. So I could get to the point where I can't perform 2 of the ADLs. The ADLs are assisted daily living. And typically those what cause people to go into nursing homes. If a person can't perform 2 of those, then you can file for chronic illness and you get a portion of the death benefit. Next slide. Milestone number 3 is emergency fund. Save 3 to 6 months of income to prepare for the unexpected expenses. Next slide. Rule of thumb, annual income, $50,000. You should have 3 months, 12.5, or 26 months, 25K. As you can see, 200,000, 3 months is 50,000, 6 months is 100,000. It's 2 rules for your emergency fund. Rule number 1, use it for emergencies. Don't use it for sales. If you come across a sale and you go take money out for emergencies. Rule number 2, I see, Dr. CJ, I see you. Rule number 2, if you have an emergency, take the money out and use it, but replenish it. Those are the 2 rules. Next slide. Milestone number 4, debt management. Change spending habits, strive to eliminate debt. Next slide. 5 tips to stay out of debt. Know what you owe. No more late payments. Target one debt at a time. Stop charging, cancel and unused subscriptions, and refinance your mortgage if it makes sense to refinance. Because when you refinance, you do pay more money and you stretch it out. So, but if it does make sense to refinance when you run the numbers, that may be a way to get out debt. Now, I want to say a couple of things on this getting out of debt. There's 2 things I would recommend highly. Mint.com. There's an app, a free app you can download. You can connect your accounts. You can track your money. It's free. There's another app called privacy.com. It's free. You can do it online and also on the app. Privacy.com is good. Like if you have subscriptions or you set up something that gives you a free trial and then you put your credit card or debit card on there and then you forget, well, privacy.com is a virtual credit card. You put the amount on there that you want. And when that trial is up, it'll send you an email. Oh, try to charge, but it declined because you set that up, that free trial, that you won't have to worry about your cards being dinged. And you got to call in. You may get your money back. You may not get the money back. So privacy.com and also mint.com. It's great tools. Next slide. Increase cash flow, earn additional expenses, manage the additional income and manage the expenses. Next slide. I'm not going to go all through these for the sake of time because you guys do have the presentation. Next slide, because it's something that I do really want to cover a couple of things. Next slide. Number 6, build wealth, avoid the impact of taxes, losses, and inflation. Next slide. Next slide. 4 threats. Procrastination is probably the biggest. You put it off. Losses, inflation, and taxes. Next slide. Next slide. We talked about the rule of 72, the impact of losses. If you have a stock market loss, some people think if you lose 50%, it takes you 50% to get back to a whole. No, it takes you 100% to get back that 50% you lost. So just be aware of that. Next slide. Taxes. 2 things I want you to remember when we deal with this taxes and also when we deal with the rule of 72. 2 things I really want you to remember. Okay, next slide. All right, so the seed versus the harvest. So the seed, if you save $10,000 at age 29 and earn a 9% annual return each year, you would have $250,000 when you reach age 65. So here's the question. Would you want to pay taxes on the $10,000 or the $250,000? $10,000 is a seed. The $250,000 is the harvest. Put in the chat which one you would prefer to pay taxes on, the seed or the harvest. All right. 3 ways you can be taxed. Tax now. Taxes are paid on interest, earnings, and dividends each single year. This is your W-2 income. This is your capital gains taxes. This you pay now. It's taxable. Tax later is tax deferred. Taxes are paid when you start taking distributions. That is your 401k, your 403b, your deferred comp, and your traditional IRAs. The taxes are deferred. Then that's tax never. This is where you want to have a lot of money in. Tax never. Taxes are not owed on earnings and distributions. There's 2 options for tax never. Roth IRA and cash value life insurance. Next slide. Next slide. Number 7 is protecting wealth, create a will, guard your legacy. Next slide. Prince died in 2016. His estate was valued at $150 million. I don't think they've settled his case yet. And 64% of Americans don't even have a will. Now, if you die without a will, most people do not want the government in their affairs or their business. So you got 2 choices. If you don't want the government in your affairs, then get a will. If you don't have a will, the government is in your affairs. They would dictate to where your assets goes if you don't have a will. So get your will so you can dictate where your assets go. Aretha Franklin died in 2018. two of her sons are now, this was 2 weeks ago, they're still litigating and in court on about her her estate. One said she had a written will some few years back. The other one said that she put something verbally. So they're fighting because there was no estate plan here. So make sure you have an estate plan. A will is a non-negotiable. Next slide. 4 documents you should have: will, financial power of attorney, advanced healthcare directive, or living will, and HIPAA release. Those are 4 documents that you should have in your estate plan. Next slide. The process of administering an estate is called probate. Probate is where you spend money on court costs and fees for not having an estate set up. Next slide. Trust. Everybody doesn't need a trust, so you would talk to an attorney, but you could set up a trust to help protect you from property, protects interests of your children. If you have special needs children, if you leave a life insurance policy, it could affect their benefits. So you want to set up a trust for special needs children, also to avoid probate. If you have property in multiple states, these are things are important to have trust set up. Everybody doesn't need a trust, but talk to an attorney. Next slide. Think estate planning will be too expensive or time consuming. Wait till your beneficiaries have to deal with it. Next slide. Discuss these concepts and review the milestones with a financial professional. Don't procrastinate. Set up a meeting today. That's all I got, Dr. CJ. Thank you for the opportunity. I hope I didn't go too fast.
Sorry, I was muted. I was like, I was dying when you showed me 69 slides. I'm like, Troy, you're killing me. Stop. Because my slides are usually just really small, and my students know, Morgan and one knows. I was like, oh. But this was great, and that's why I wanted to share it with you guys, because we can only go over so much, and sometimes you like, whoa, you're going too fast. And this is your time to just look at what it's there, and it's really happening. This is actually happening right now. I'm sharing my business now, but one of my family member is incapacitated and doesn't have a will, or the will is old and now she has to do it, but she forgot to have a power of attorney.
Yeah.
And she has multiple kids, ex-husband, and trying to get into the dibs. And I'm like, oh my God, that's so complicated.
Yeah.
And I even asked my husband, I'm like, are you sure you don't have any kids anywhere else? Because like, you know how my grandpa died and we didn't know he had another family, and this lady cried more than my grandma, and we looked at her and we're like, I'm sorry, who are you?
Right.
And she's like, oh, James is my husband. I'm like, since when? Because we have 16 kids here. You know what I mean? Like, it happens. And the will, especially if your family have money, it's really difficult. So having power of attorney is super important to have, to make sure that your whatever else that you have is protected. So thank you so much, Troy. Do you guys have any questions for Troy, by the way? Anybody?
Do you have any recommendation on the permanent life insurance companies?
Yeah, I mean, not all of them are created equal. So for me, I have access to about 200 different carriers, and it all depends on various factors. So when I sit down with somebody, we dive deep and try to figure out their goals and objectives. It's important that you got to look at what benefits that they have, like the what they call the living benefits riders, and then you want to also look at how the policy will what's the word I'm looking for, project on the theoretical. So there's a theoretical illustration, is a theoretical projection, and so you want to look at that. So there's some factors to look in, but there are a few that I really like. And then there's some that are not so good, but yeah. But Juan, if you want to reach out to me, we can talk more. There's no obligation. Anybody got any questions, you can set up an appointment with me. We can have a conversation. There's no obligation. I answer all the questions that I can. Any other questions? Because it's something I want to add before another question.
Sure, go ahead.
I know somebody else got a question. I know I didn't do the perfect presentation.
No, your presentation was so informational, but it's one of those lectures that is a lot to take
Yeah.
in. So it's going to take us a minute, even myself, a minute to kind of review because I do have life insurance, but it's
Mhm.
certainly not 10 times my income or my husband's income. So that because life is hard and money is hard to come by, but my life insurance, I think I've been paying for 10 years now.
Yeah.
I think my thought is how much does it cost to bury me? I'm
Yeah.
demanding when I die, I told them I need my glitter coffin. I swear I'm coming back if I don't have a glitter coffin. Okay.
At least
You know you can
50,000.
prepay
At
for
least
all
fifty
that, right?
thousand. If you want a glitter coffin, at least
Yeah.
50,000. My grandmother had a copper coffin, and hers was around 48,000 for the headstone for the coffin, and that was 9 years ago.
Wow.
I can tell
Yeah.
you that the cheapest way, if you have to bury a loved one, the cheapest way is to do cremation. And at this point, you're looking at $3,000 for cremation. And that's to borrow a box to put the ashes in on the counter when you have the service. And then you give them the box back.
And my wife,
Because I
she
buried my
knows-
dad in 2015.
Yeah. My
Telling you.
wife.
And he didn't have any of this. He had none of this. I had to set
Yeah.
up. My dad he got diagnosed with metastatic melanoma, had no will, had not done his taxes in 8 years,
Wow.
was a hoarder. I had to gut his house, clean the house so that he could even come back and live in after surgery, put his taxes together, catch up on 8 years of taxes and get the IRS to forgive what he owed, set up his will, set up his power of attorney, set up his healthcare power of attorney. He was already too debilitated. We went in to sign the paperwork and he would not sign over his actual, he was not ready to sign over the financial power of attorney. And I was fine with that. But he went ahead and gave me the healthcare power of attorney so that I could rule on that. But within 2 weeks, he was too incapacitated for my family, for my uncle, who was the attorney, for any of us to feel comfortable for him to sign that. So my aunt, who was the estate, who was going to be the executor of the estate, we just handed the finances to her, and he didn't last but 3 more weeks. So
Wow.
yeah, he
So
was
sad.
gone. He was gone in less than 6 months. So when you get dumped with this and you have to clean it up for somebody else, I mean, you have to book it. I was really lucky to get all of his stuff done in that tiny little time period because I didn't think it was going to be that short, but it was.
My mother-in-law died on September, and the financial burden, like where do we get this money to get this done in like a week? And we
Yeah.
had to postpone everything because everyone can't fly, everyone's the drama, and then you're already in grief. Like you don't need
Yeah.
extra issue. But I feel like people, when you're vulnerable, people just hit you up more for money. And
True.
I'm like, where do you get this idea? I feel like I need my village to calm me down. But it was a difficult time last year. It's like when your loved one died, it's even that. But you're right, it is 50,000. I'm not even demanding a see-through pink coffin. I'm just pink coffin with glitter. That's all, guys. That's what I tell my kids. And she's like, Mom, you're gonna get a sticker of glitter. That's all you're getting. We're going to Michael's. I was like,
I'll
oh
paint it
no.
for you if I'm still
Right?
around.
Oh my God. But thank you so
Just
much.
some
for
glitter
your
spray
time.
paint.
Let
Yeah,
me,
Yeah,
there we go.
right?
let me
Oh, there's
ask.
But you
gold ones
can
out there.
actually prepay for all of this. My mom
Yeah, you
has
can.
hers all set up already so that me and
Mm-hmm.
my sister and the kids don't have to worry about it.
Yep, you can.
She's
Let me
got
s-
hers already prepaid and done, except she doesn't live in that state anymore. But I'm pretty sure she's transferred it to California from
Mhm.
Florida. Mhm.
I want to say this. If you
Mhm.
have a life insurance policy and your children, minor children, are beneficiary, I don't recommend you keep it like that. Here's the reason why. I have a friend of mine, pastor friend of mine. His wife died. They had been married 25 years. The wife passed, and the wife had life insurance through the job and had the 2 minor children as beneficiary. They're living together and they good, happy marriage. So he had to go to court, hire a attorney to prove that he's the guardian of his own children. So there's court costs and there's court fees because the wife made the mistake and made the minor children as beneficiaries. So my recommendation is set up a trust or someone that you really trust in the event if you pass.
Definitely a trust. It
Yes.
saves so much time
Yes.
and everything. When my sister passed away, I was so grateful that my mom and I had set up the trust years before. it made transitioning with the condo and being able to get it sold quickly and everything so much easier. I was able to have it all done within 3 months instead of 2 years.
Yeah.
Wow.
So
Well, what if-
definitely a trust.
What if you put your spouse and your children?
Your spouse would be basically the executor.
Yeah. Right.
And
Mhm.
he would be in charge of all of it and then would allocate what your children get. And if they're over the age of 18 or 25, whichever you set it for, he would then proceed to release it to them.
One of my daughters is 18, one is the other one is 15. It's not like I'm planning to die any time
Yeah,
now.
no.
Yeah, no.
Just
So the
saying,
15-year-old, you want to
Most
have
trusts
it.
are usually set up for 25 because they
Well-
feel you're mentally stable enough
Cable, yeah.
to be able to handle any kind of a trust. They're usually set up for 25 with like exceptions for college and things like that.
Yeah.
Okay.
Mm.
But
I
if-
definitely
but-
need a lawyer.
Yeah. But if the 15-year-old, if something happened to you and your husband and your 15-year-old is the beneficiary, then that part, they're going to have to get a guardian, go to court costs and all that. So you want to set it up where minor children, because they're not legally able to receive the funds. They'll get the funds, but some of it's going to be less because you got to pay court costs and attorney fees and things like that. So my tip is to many people didn't think about, well, I want to leave this money for my children and the minor children, and they don't realize what happens when they pass and the minor children are the beneficiary.
That's awesome. Thank you so much for this information. Thank you
You're
guys for
welcome.
coming, and I will post the video on YouTube once I get to it, and then the certificate will come probably by Friday or sometime next week for sure.
The
And
club link you were talking about?
the what? No, the club
cl-
link is already on here. I already put you
Okay.
guys as in the club link, levelupdoc.club.
Oh,
And I'll
okay.
send, if you're having issues, let me know.
Looking for it, I just didn't see it.
Oh, okay. Yeah, it's levelupdoc.club.
Mhm.
Levelupdoc.club. Yep,
Well,
there it is.
mhm.
But if you guys have anything, I'll put Troy in that directory, or hopefully Troy will put his self in
will.
the directory. So
Yeah.
feel free to put your information in a directory once you guys are in. And then don't get banned, okay? Because I don't do nonsense. I just want you to know. Once you're in, be nice, be kind. Even if you don't like somebody, it's fine. This is a professional area where we can do business with each other, but just be kind is all I'm asking.
You
Just be-
Have a
cannot
nice
like
day,
someone and
everybody.
be kind and respectful. Mhm.
Yes, that is so true.
Thank you, Dr. CJ, and it's
Bye.
nice meeting
Enjoyed
everybody.
it.
Thank
you
y'all.
for inviting me. Bye, guys.
Bye, everybody. Thank you for coming.